Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. I'm recording this chart book on the Fed on Monday, the 28th, ahead of the Fed meeting. We're publishing this ahead of each Fed meeting. And obviously what has happened this time since the last Fed meeting is that the market has had a bit of a tantrum. And we've had, I called it some flip-flopping in a Merk Insights that's available on our web page. And I want to give you a little bit of context. As always, this is my in-between the lines reading. You can download the PDF at merkinvestments.com/research. The blue text here is Nick's take on these things, and I'm giving you my spin of things. You've seen this chart many times. The one thing I might want to point out is when we talk about the estimated longer run at the Fed, which is based on the surveys that's happening of the FOMC member, this is not a fixed line. Over time, this longer run rate does vary. And the relevance here is that in this context, the folks at the Fed believe we still have the foot on the accelerator. And Powell recently indicated we're now in the quote-unquote neutral range, and that's plausible because this isn't an exact science. There is quite some leeway here in the interpretation. But still, we are not in what the Fed would consider tight policy. We've maybe taken the foot off the accelerator, and indeed Powell was more specific. We are now at what some people believe is the lower range of what some would consider neutral. And the reason that's all relevant is that if you believe that there is inflationary pressure in the system, you don't want to be at neutral. If you think that unemployment is at a level where it's not sustainable because it's too low, we should not be at this neutral level. Whereas if you think that this is all perfect, we can coast at this level for an extended period, by all means, this may be appropriate. And so obviously we now have a Fed that's decided to be a little bit of quiet, a little bit of patience on the sidelines. Powell talks about being in this dark room where he's waiting along. So we've had many of these hikes here. Some people have criticized that they should have hiked earlier, then they wouldn't have needed to be quite so persistent in hiking. Now, again, I've mentioned this many times, the whole point of rate hikes is to tighten financial conditions. That's why rates are being hiked. Janet Yellen, when she talked about paint drying on the wall, that was a reference to quantitative tightening. It was because they didn't know what the market impact would be. And so she kind of said, oh, I'll just do it, but don't take it too seriously, right? And so in the meantime, a lot of things have happened. Quantitative tightening has been underway. The Fed has been hiking, and sure enough, we've had some dominoes fall from some jitters in emerging markets to obviously then the more pronounced impact was the sell-off in the high yield sector we saw end of last year, the sell of risk assets and so forth. And the question is there a time for the Fed to pause, right? You can look at some of these here in more detail. What I want to show you is this is what's priced in a year from now. And so we had been steadily moving higher, and then we kind of hit this wall where I then said, oh my God, not so fast, not so fast. What I do want to point out, to keep this discussion a tad more rational than maybe even the Fed might dare to do, is when the rate hike expectations at the end of the third quarter were very high going forward, the positioning in the market based on the futures data that's available suggests that a lot of people in the market were short rates. And that means that as people then looked forward to what they're going to do for the current year, 2019, they might have wanted to take some of the shorts off the table. And what happens when a few people do something, everybody else says, well, maybe we should do the same thing. I mean, you can call it a short squeeze, you can call it a repositioning, but I wouldn't be surprised that a lot of what happened in the market was merely a reposition in the market exacerbated by the fact that people had been so short. But never mind, if you're a journalist, you have to put words into the mouth of the market. You got to have an interpretation, and the interpretation was that the economy is falling off a cliff, that it is impossible to hike rates more, we should be cutting rates. And sure enough, that kind of gave a life on its own. And when you walk dark in a room and don't know exactly where you're heading, well, maybe you're going to look at that tail that's wagging you, and you're going to say, okay, maybe maybe it is the right thing to do to be a bit slower here. And as you can see, there's a little bit of cynicism in my voice here. And now here, as we go to the next chart, there is no such thing as inflation in the market, right? Look at the inflation readings. They have come down. I believe the next one is inflation expectations, market-based inflation expectations here, based on the TIPS, the Treasury Inflation Protected Securities. Now, what's not shown here is that those in market-based inflation expectations are very, very highly correlated, in our analysis at least, to the price of oil. And as this is highly correlated to the price of oil had come down, and that lowered inflation expectations. It doesn't make a great deal of sense if you think about it. The price of oil is a current price of oil, and this one is longer-term inflation expectations. So in this particular chart is what inflation will be over 10 years. Inflation over 10 years shouldn't really be impacted so much of what's happening in the short-term in the oil market, but that's how these inflation, market-based inflation numbers work. That's part of the reason why the Fed likes to look at survey-based ones. They're pretty dull, the survey-based ones. They don't really tell you much what to do. Now, the reason why this is still very relevant is that with the low oil prices we had at the end of last year, if you fast forward a year to the end of 2019, the year-over-year comparisons will lead to high headline inflation. And because it may lead to high headline inflation, it could also increase inflation expectations. So what I'm trying to say here is that while everybody was kind of running for the hills at the beginning of this year, at the end of this year, this may look very different. And obviously, when you deal in the markets, you hear the survey-based ones. When you're dealing with the markets, there is an opportunity potentially to kind of take a different stance if the short-term market reaction is different, how things may look in the medium term. This chart here shows the unemployment rate that's been coming down, and very notably, wage pressures moving higher. And that is a key thing I'm concerned about. Wages continue to move higher. In the US, abroad, by the way, just as much or even more in some places. As I talk, there's a strike in the Hungarian car that makes engines, and they're demanding 18% more in wages. And the company has offered 10% more this year and 10% next year. Now, clearly, Hungary has a very different wage level and so forth, environment. I'm not saying that's kind of the general thing happening everywhere. They happen to be a supplier to a German car manufacturer that currently is out of engines in some plants. But back to the US, for a long time in recent years, it had been that top executives were making a boatload of money, but it hadn't, quote unquote, trickled through to the entry-level worker. That appears to have changed. Anecdotal evidence that we are hearing suggests, and some other statistics suggest, that that there are higher wages being not just demanded, but also offered to employees who historically have had lower wages. And so very much in line with this upswing here, which does suggest that there are wage pressures. Now, Powell has been shrugging this off, referring to higher productivity. That is correct. There is higher productivity of late, but I do not think that higher productivity is sufficiently making up for those wage pressures. And so I do think that it is not the right time for the Fed to be in neutral. They should be in tightening mode, which they are not. And keep in mind, it is not the Fed's role to make sure the stock market is happy. Greenspan was a believer in the wealth effect. Powell doesn't mention that so much. So Greenspan was much more sensitive to that. Also, it is not the Fed's role to ensure that iPhones are sold in China. And again, of course, that's a bit cynical, that comment, but it is the US economy that the Fed is supposed to worry about. From what we can see, the consumer is very healthy. Here again, another unemployment number. Job gains are doing just fine. The JOLTS report, it's a Yellen favorite, is doing all right. The labor force participation rate, that's kind of been the savior of why we don't have so much inflation, is because people are coming from the sidelines. Prime age workers, this is. different submetrics, whatever it is, but a lot of people had been out on disability when they didn't qualify for regular unemployment insurance anymore. And it's not that easy to get off disability, but the strong labor market has encouraged people to join the labor force again. And that's, of course, a good sign. Question is how long that continue. We think there's a few more months in that. But again, that policy is forward-looking, and therefore something may need to be done ahead of time. Here is the prime age male labor participation rate. The reason we have this dashed line here is because we think that if and when we break through that dashed line, we may have exhausted the pool of available labor. There's no scientific backing behind that dashed line. That's just our impression based on this long-term trend, and that obviously suggests we might have several more months in that. Financial conditions. Again, as I mentioned, the point of Fed tightening is to tighten financial conditions. And guess what? That hasn't really happened based on this indicator. We happen to like the Chicago Fed National Financial Conditions Index. Volatility in the stock market is not a highly relevant indicator of financial conditions. What matters, we don't have it here, so I go right back, is the availability of credit for corporations. And while on the high yield market, the issuances have dried up, still credit is still quite available. Quantitative tightening, the big challenge the Fed has is they don't know what they're doing. Now, I'm not trying to be too critical here, but they don't know where they want to take this. They've had debates, and this is all based on my interpretation, of course. They've had debates, then decided they would pursue on QT, but they don't know where this is going to end. And that's what I mean with they don't know what they're doing. There's one camp, but it's a minuscule camp at the Fed that says, hey, let's get rid of the excess reserves, all the extra money we don't really need. A higher level of the Fed that was pre-crisis, but mostly because there's more cash in circulation. But there's a much larger camp that says, no, let's have a bigger buffer here. We want to use interest on excess reserves as a primary policy tool. Let's not get back to the old ways where we intervene based on market, on treasury operations, on juggling this market. They think it's a better way to keep a larger balance sheet, but they never specified it. And based on my assessment, I strongly believe that the Fed thought that they have until late this year to decide on where they want to take it. And guess what? The market said, no, we want to know now. That's part of what this tantrum was about. And sure enough, now the Fed has promised that they'll give some clarity. And so the Fed meeting that's coming up suggests very clearly that they might want to clarify this. I do not know that they can actually come to an agreement because there is no academic foundation that tells them where exactly they want to take it, and creating some artificial clarity doesn't help either. So it's going to be interesting. Not sure how strongly the market will react. I don't think quantitative tightening has been the main driver of the market. It's gotten additional attention because obviously the ECB in Europe has now stopped printing. The Japanese, though, still print. And also, we have a lot of debt issuance by the federal government, which is a far more overwhelming, in my view, than what's happening here on the balance sheet. So this is but one component of what's happening in the market. The dollar seems to be topping out here. Maybe that's my biased opinion. Not sure whether I'm biased here or not, but this idea that and by the way, as I think I've made clear here, I don't think we're at the end of the tightening cycle. I think after a pause, we'll probably get two more hikes later this year. But still, any news that appears to be coming out seems to corroborate this idea that we're nearing the end. Whereas in Europe, because the dollar index is heavily weighted towards the euro, while yes, Draghi has downgraded the economy, he's made several statements that suggest that all the negatives they see, there are solutions to each one of them. And the only reason they're doing the downgrade is because sentiment has now been impacted by this prolonged period of uncertainty. But Draghi is retiring, so I think he's tempted to raise before he retires, simply because if history is any guide with Bernanke and Yellen that were more hawkish towards the end of their term, Draghi may do that. The successor to Draghi, I cannot imagine to be more dovish than Draghi. And also inflationary pressures in Europe are also rising. I just mentioned this Hungarian example of very substantial wage pressures. Unemployment rate in Germany is extremely low. There are reasons there as well to take the foot off the accelerator. That's the dot plot. You can study that in depth. Here, a table. Please download the table. I'm not going to talk about this too much. And if you want to dive into depth here on those folks, if you want to look here at Kaplan, I mentioned earlier, who is kind of the one who's most concerned about international things happening. He's not voting right now, for what that's worth. And so here's a little summary. First, the academic part that may be actually, since Nick created this, he reshuffled some paragraphs here. So he's not first having that paragraph here, but he put this here in the end that this can kind of go both ways. But if you read this paragraph here, it kind of shows how the Fed is quote unquote flexible. And of course, yes, the Fed. One of the views on the Fed is that they have to have a nuanced approach. And so, yeah, the market a little bit overreacts. So let's take it a little bit more slowly. And that's all fair. What does seem to have happened here, though, is that the Fed was a bit overwhelmed with the tantrum that was thrown. And so we'll see how that gets further to be navigated. My baseline is still inflationary pressures continue to rise, and that in that context, the Fed will be pretty much coerced to hike rates further. With that, please enjoy the disclosure. Tell your friends about this premium chart book series here, and please give us your feedback. And with that, I look forward to seeing, listening to you, or talking to you in some other venue. Thanks then. Bye-bye.